I think it's a good time to get started. If we have more attendees logging on in another minute or so, I don't think they'll miss out on much. I'm very happy today that we are joined with the guys from First Trust. First Trust is a partner of ours. We have used First Trust investments in the portfolios here at Ford Financial Group for some time, and our speaker today specifically is Andrew. Andrew, help me with your last name. It's Updike.
Updike, like it should be spelled with a U.
I got it. That's okay. I feel for you because my last name gets mispronounced and misspelled all the time. I will, at Andrew's request, I'm going to save you the big long bio, but he's a CFA and he's on the economics team at First Trust. And we really do value the commentary and input that we get from that First Trust economics team, because it really does help us craft better portfolios here. And I think an important takeaway for Andrew and the First Trust economic team is that they live in the economic data, and they are going through it all the time to try and slice the bologna thinner and see if there are some insights that we can glean from it. And they are ranked by Bloomberg as one of the most accurate economic forecasting teams out there. And what I appreciate from them is that there is no spin, and they let the data do the talking for us. And so with that, Andrew, I'm going to hand it over to you, and you can roll through your slide deck, and I'll just remind everybody, well, I'll introduce myself if I don't know you. My name is Brian Ullman. I'm one of the managing partners here at Ford Financial Group, and I will be your moderator today as we roll through the questions as we get through the slides. So, Andrew, I'll hand it over to you.
Brian, thank you so much for the introduction. Welcome, everybody. Good time to be having a conversation. Clearly, there is no shortage of things to be talking about this year. And, we get to have this conversation. Me, Brian, the team over at Ford Financial, we get to have this discussion on an ongoing basis. But I love that we kind of get to have this conversation with you today and talk about what are we seeing in the data. And the data, to me, is critically important. When we live in times like these, where you turn on the TV, you turn on the radio, you open up the newspaper, we are inundated with negativity. We are constantly hearing about the worst of what's out there. It bleeds, it leads. If it sells advertising, it's going to show up on TV. And this got amplified the other week because we got data for the second quarter of economic activity in the United States. It was negative. It showed the economy declined in Q2 after declining in the first quarter of this year. And the R word started popping up everywhere. You turn on the TV and they start talking about, are we in a recession? Are we going into a recession? Now, let me remind you real quick, before we dive deeper into the data, 2022 was going to be a more difficult year compared to last year, compared to the second half of 2020, because in the recovery, the early stages, and as we went through last year, right, we were benefiting from $5.5 trillion of economic stimulus, which I'll call that economic morphine. It helped cover up the pain of what was taking place. It helped ease the pain when businesses were shut down, not because they had bad products, right? Not because they had bad service. They were shut down for health and safety reasons. Now, some of those doors didn't reopen. But the easing, that painkiller that was stimulus, helped ease the path back. Now, one of the problems you have with something like economic morphine is once the injections stop, once the morphine stops flowing, once the painkillers get pulled away, if you haven't fixed the underlying issues, there's going to be some difficulty. There's going to be some discomfort. Now, because of that pullback and the checks are now behind us, there were questions coming into this year on what it would look like. It was going to slow. We weren't going to see quite the same benefit from reopening that we did in 2021. Now, that didn't mean that we couldn't continue expanding. It didn't mean that a recession was inevitable, but it meant that we needed to readjust expectations and be realistic about what this year would bring. Now, the key question of are we in a recession or are we going into a recession, this is a tricky one. Because if you took Econ 101 back in school, that class that so many people fell asleep in, if you took economics, they probably told you the definition of a recession is back-to-back quarters of negative growth. And that's kind of the rule of thumb definition. That's the easy, quick explanation, generally what we're looking for in a recession, but it's not the official definition. It's not what determines for the history books if we were in a recession. There's only one group that can do that. They're called the NBER. It's the National Bureau of Economic Research. It's a handful of economists like myself that sit around and debate this in a room. We're an absolute hoot of a group to hang out with. And the NBER usually tells us about a year after the fact that we went into a recession, and they tell us about a year after the fact that we're out. They're not the most timely fellows, but they are clear on what they're looking for. They have it on their website. They've spoken about it numerous times. What determines if the U.S. is in a recession is if we're seeing a broad-based slowdown in economic activity. When they say broad-based, they care about what's happening with employment, what's happening with manufacturing, what's happening with production, what's happening with consumption. What's interesting is if you dive into the details of the declines we had in the first and second quarter of this year, they were very concentrated. In Q1, it was concentrated in international trade. What happened was Omicron hit in January, particularly emerging market countries, and because of that, they bought less from us. Now, that number turned in February, March, April, May, June. Okay, that's the data we have so far. That number has shifted since the start of the year. That was a temporary factor. Okay, but because of that one key area, first quarter activity declined. You take that out, we grew in the first quarter. In the second quarter, it was inventories. Again, business investment was fine. Consumption by consumers was fine. The issue had to do with inventories. Now, this is something, again, you may have heard. You may have heard that Walmart, that Target, that Bed Bath & Beyond are starting to discount some of their merchandise again. And when I hear this, it's typically been framed as the consumer is weakening. The consumer is weakening, things are slowing down, this is the sign of a recession. But if you actually listen, Target came out and announced that they were going to be doing some of these inventory adjustments. They put out a press release, that got the headlines, then they did a 25-minute call with their chief financial officer. And this chief financial officer, okay, not that many people actually listened to the call. That's my job. When I listened to the call, he said, first off, let me be clear. The spending is still taking place. And we see this in data like retail sales, which continues to climb. It's at all-time highs. He said, look, the issue that we have today is not that consumers aren't coming in our door. It's not that they're not spending. The problem that we had is that in order to have goods available for sale this summer, in order to have things in the stores, it wasn't like normal times where we order it 3 months in advance. We had to order it 9 to 12 months in advance. Because of supply chain difficulties, because of shortages, we had to be far more, you said they had to guess. They had to guess, they had to try to anticipate last summer what this summer was going to look like. Okay, and when they did that, they ended up missing the boat. Because when they made these decisions last summer, they thought it would look this year, again, like what we were seeing last year, that people would be spending more time at home. They'd be doing a little bit more stuff around the house. They would be getting the lawn furniture in the backyard. Now, there's a couple factors that have impacted the shift in consumer activity. We're seeing things like consumers are spending more, yes, on gas. They're spending more on food. Now, let me note back here, 2001 to about 2007, okay, oil prices rose from $40 to about $140. Did you see a notable change in consumer purchases? The answer is no, but you did if you dug into the details. They shifted what they bought, even while they continued to buy at similar levels. Likewise, in 14 to 16, when the U.S. fracking boom was exploding and Saudi Arabia came in, dumped oil on the market to try to slow down activity, oil prices dropped from $120 a barrel to $40. Did we see a huge spike in consumer spending because they paid less at the pump? The answer was no. They kept spending, but again, their activity shifted. And they said, okay, we're Target, we're Walmart, we're Costco. People are spending more on the food. They're spending more on gas. They're not spending as much on some of the outdoor stuff. They said, you know what the other thing is that we can't keep in stock right now? It's luggage. Now, I travel on a pretty much a daily basis. I'm on the road most days. Last week, I was north of you. I was up in San Francisco, in Walnut Creek, in Danville, up in Sonoma. This week, right after this, I'm going to be heading out to Ohio. The week before I was in California, I was in New York. I've been on the road. I've taken about 25 flights or 25 trips this year. I'm about 50 flights. Okay, I go East Coast, West Coast, North, South, across the Midwest. I visit both the Dakotas in every year. I want to watch and see what is taking place across the country. I'm talking with business owners to see, because the reopening, the getting back to work, how the economy is progressing can look very different and does look very different depending on where you are in the country. But one thing that I've seen consistently is at the airports. As I went through Newark Airport 2 weeks ago, it was absolutely slammed. And I got on my flight, and the first thing I did is I pulled up United's most recent report. They just did their earnings call. They just talked about the business activity. And I said, look, I'm seeing consumer demand that remains high. Not as it's not growing at the same speed that it did last year, because this was a check, and this was a check, and this was a check. When the checks came through, you don't need an economics degree to understand. You give people money, they will spend it. But I'm still seeing the spending, and I'm seeing massive demand in the airports. And United came out and said, we just can't keep up. We can't keep up. Right now, we don't have enough baggage handlers. Right now, we don't have enough ground crew. Demand for personal travel is at all-time highs. Business travel is getting there. But because of staffing issues, we're going to have some difficulty hitting targets through the remainder of this year. Now, I hear this, and I said, okay, well, consumers have money to spend. Where do they stand? Where are consumers today relative to where they were pre-COVID? Because with the checks behind us, if that was that economic morphine, if it created a sugar high, once that money's been eaten through, we have to get back to the fundamentals. We have to get back to paychecks. We have to get back to the sustainable spending power over time. So I've spent a lot of time recently with conversations with the banks. JP Morgan, Bank of America, Citibank, Wells Fargo, talking to regional banks. I said, where are your consumers? Are they healthy? Are they comfortable? Are they stretched? Because when they get stretched, that's when we start to get concerned. Economic turbulence, a slowdown in activity leads to more bankruptcies. It leads to more job losses. When companies are stretched, they have to pull back on projects. So I went to the banks, and they pointed me to this number, the financial obligations ratio. Now, that's fancy bank speak. What they're looking at is they're saying what percent of after-tax income, the money that clears through your check and into your account, okay? So we've taken out the income tax. We've taken out Social Security tax. They ask how much of the money that hits your account do you need to spend for your existing obligations? Think your house, your car, your student loans, your credit card payments. How much of the money that you have coming in needs to go right back out to cover expenses from the past? Now, this number matters when it rises. And this is something that we saw going into the financial crisis. When consumers get stretched, that economic volatility hits, it can intensify a downturn. And when we went through the financial crisis, this was a painful deleveraging for consumers. It was a forced deleveraging. They lost homes. We had bankruptcies. We had foreclosures. Now, the good news is that when we went through the recovery period after the financial crisis, that 10-year period leading up to COVID, consumers had kept their balance sheets at some of the healthiest levels that we have seen since at least 1980. And I say at least because that's when the data started. It looks like it may have been healthier than what we saw in the 70s and the 60s, but we can't say for sure because we didn't start tracking it yet. But going into COVID, consumers were in a healthy position, as were the banks. The banks that had the difficulties during the financial crisis in response to the crisis. Consumers, businesses, banks, the government respond to the last crisis. They always build protection so that what happened before won't happen again. They were fortresses coming into COVID. COVID hits. First thing you see is consumers delever further. This, in the early stages, was them pulling back on credit cards. They said, look, I don't know if my job's going to be here in a month, 3 months, 5 months. And if I don't know if my job's going to be there, I'm not putting payments down on a 25, 28% interest rate credit card. They pulled back. Now, consumption. I look again at this chart, and you can see, unlike the financial crisis, retail sales was growing at a trend beforehand, growing at a trend afterwards. It took about 2 years for activity to come back and set new highs. This time, we were setting new highs by the end of 2020. After that initial period, March and April, once we started to get into May, June, activity turned. But this number continued to move lower. So what was going on? Again, I went back to the banks and I said, what was happening here? And they said, well, you remember when mortgage rates were going from 4% to 3.75, 3.5, 3.25, 3%? And I said, yeah, I remember when that was taking place. They said people were refinancing. They locked in lower rates. Now, what's interesting is you come back here again. You go pre-financial crisis. Back here, roughly 50% of all outstanding mortgages were adjustable rate mortgages. So when the Fed started to tighten, when the numbers started to rise, it was impacting homeowners. Homeowners who were already stretched got stretched even further. This time around, that's completely changed. The bank said, hey, we're not doing that anymore. We're not doing the adjustable rate mortgages. We have higher standards on credit quality. Back in the financial crisis, we had the ninja loans. No income, no job application. You didn't even need to prove that you had an income stream in order to get a house. That did not happen over the last 10 years. Today, we have less than 10% of mortgages are adjustable rate mortgages. Okay, so they started locking in lower and lower rates. So yes, mortgage rates went from 3% to 6%. Now they're kind of in that 5 to 6% range. If you go to buy a house today, it's more expensive than it was a year ago. But if you refinance that home a year ago, you haven't been impacted by that rise in rates. Okay, and likewise, companies did something similar. In 2020 and into 2021, they refinanced their debt. They said, look, the U.S. has a 100% recovery rate. They've always come back from recessions. They've always come back from market downturns. And these companies said, we're going to be there when that recovery starts. We need the cash, we need the capital to invest in people and products and projects. So the banks say, look, when I look at the data, the consumers look about the healthiest that we have seen them in our lifetimes running these organizations. And they said, you know what, it's not even just that they've got their fiscal house in order on the balance sheet side, that they've kind of managed the debt to the income. During this time period, they also built up significant cash balances. When I look at checkable deposits and currency, this doesn't include savings accounts. This is the cash and cash equivalents that got built up during COVID. We went from about $1 trillion of this in the system to over $4.5 trillion. So Jamie Dimon, who you may have heard, there was a comment 2 months ago where he said there may be a hurricane on the horizon. He got asked about this during their latest earnings call because he's talking about the health of the consumer. He's talking about the health of the business. An analyst came on and said, Jamie, I need you to reconcile what you're saying today with what you told us a month and a half ago. And Jamie Dimon said, look, there's going to be turbulence because you can't spend $5.5 trillion and not expect inflation. And it's not just us that did it. Germany did it, Mexico did it, France did it, the United Kingdom, Canada. You go almost anywhere in the world, they're dealing with above trend inflation because of the spending. And now they need to raise interest rates. And that's going to make it more expensive to borrow and buy a house, more expensive to borrow and buy a car, more expensive to borrow and invest in a business. It's going to have some volatility that comes with it. He said, what I need to be clear of is that our consumers, this is not a debt crisis. This is not 0809. It looks more like a 9091. Okay, things will slow. We will likely have a recession at some point. I expect it's going to be late next year into early 2024, but it's not as severe. This isn't Hurricane Sandy. This is a hurricane that's coming in. And you know what? Quite honestly, the Bank of America CEO, who's based out in Charlotte, said, we see hurricanes out here every year. So what do? We prepare for them. We prepare for them. We build up our balance sheets. We make sure that people are safe. We button down the hatches. We're ready to go through this, and we will go through it. And we'll come out on the other side, and we will build, we will grow. But during this time, right, they said the consumer remains a supporting factor. Now, can the consumer go out? They've got the balance sheet. They've got the cash to spend. But as I talked about with for example, United, right, there's still a mismatch. Because the demand can be there, and demand is up 30%. We are spending 30% more today on goods and services than we did pre-COVID. Now, obviously, a portion of that is inflation. We get less with each dollar. Inflation has been eating into the value of our portfolios. It's been eating into every dollar we saved. All the blood, sweat, and tears that put in to building for retirement, this inflation is a silent killer. So we want the Fed acting today. We want them more aggressive rather than less. Does that mean, again, the potential for a recession, the potential for some choppiness and volatility? It's there, but we're going to be much better served getting through it, getting reset, inflation under control, moving forward under the fundamentals. Okay, but there's this mismatch that's been here in place with massive demand and a lack, an inability to supply. While spending is up 30%, we're almost back. With the data we got last Friday telling us employment from July, we're almost back to where we were pre-COVID. Now, this was the central point for the central bank. The central bank said, here's what's going to happen with inflation. Inflation, the jobs are going to come back, the supply chain's going to ease, inflation's going to be transitory. If you remember them talking, that was the word they used, transitory. It's going to be temporary. In fact, they were so convinced that this was how things were going to play out at the end of 2020. They said inflation for last year would be 1.7%. Now, I'm going to give them a little credit, okay? They got one of the numbers correct. It was in the wrong spot. It was 7.0%, not 1.7, but they got one of the numbers. Now, I looked at that and said, okay, your models are off a little bit. 1.7, 7%, what's 5.3% among friends? Well, actually, it's a pretty big miss. And when we got to the end of last year, okay, the Fed had this chance to say, hey, we missed the boat. We were off in terms of our forecast. Now, here's the thing. The jobs did come back last year. 6.7 million jobs brought back last year. It was the single best year of job additions ever in the history of the United States. They got that part right. Jobs come back, check. How about the supply chain easing? Well, there was some easing at the edges, but we were still running short on workers. Demand clearly exceeded supply. Okay, this balance was difficult. And they came into this year and said, you know what? You're right. We're not going to say transitory anymore. But here's what's going to happen in 2022. The supply chain's going to ease, and as the jobs come back, inflation this year should be 2.7%. Remember that when we were ending 2021, at the end of last year, the Federal Reserve, the interest rate setting body in the United States, was debating whether or not we would see one rate hike this year. One rate hike of 0.25%. And then at the start of the year, they gave us that 0.25 point hike. Then they did a 50 basis point, a 0.5 percentage point hike. Then they've done 2 75s, and they're debating another 75 at the next meeting. See, what happened was they realized very early that this number was wrong. Then they changed their forecast. No, not 2.7, it's going to be 4.5. Oh, we already hit, okay, no, not 4.5. Then we're going to go about 6%. Oh, not 6%, it's going to be 6.5. They keep chasing inflation, and the reason is their model was off. Okay, yes, the jobs continue to come back. In fact, so far through July, we have 3.3 million jobs added this year. How does that compare to history? That's more than we did in calendar year 2019. In fact, to find a calendar year, 12-month period, okay, January to December, where we've added as many jobs as we did through the first 7 months this year, you have to go back to the early parts of the recovery from the financial crisis. We continue to add jobs at a rapid pace. The July number was about 500,000. Now, will that ease as we move further into the year? My expectation is yes. We're looking at 4 or 4.5 million jobs added this year, but that is a strong number. That's hands at work, hands producing, and that production leads to GDP. Those hands at work, those hands producing are getting paychecks, which is a sustainable source of spending power in a way that the stimulus checks could never be. And here in the next few months, these non-farm payrolls are going to be back to even and start setting new highs. Private payrolls, okay, which takes out government work. Government's still down a little bit, but private payrolls, businesses, are now at new highs. However, there's still a mismatch because when we get those numbers, and even if we're back to even or up a little bit at the end of this year, right, we have 30% more demand and we're back to even on the people who can produce it. So I look at this and say there's an imbalance in this equation. I'm an economist. It's supply and demand. We keep focusing on the supply side of the economy. That's what gets the news coverage. That's what makes the headlines. How is demand up 30%? How is demand up 30% as we're still recovering from COVID? And for that, I said, you need to watch, you need to follow the money. Now, I look at a number called M2. M2 is the money in the hands of consumers and businesses. This number is up 42% from where we were pre-COVID. But I get it. I'm an economist. I get excited for the M2 release. Nobody else does, okay? Everybody else, they hear M2, they want to fall asleep. Let me explain why the money in the system matters so much. Come with me for a moment to an imaginary world. Not that exciting of an imaginary world. It's an economist's imaginary world. But in this magical economy, you only have two things. You've got $10 and you've got 10 apples. This is your world. In this world with $10 and 10 apples, how much is an apple going to cost you? And you run the math and you said, okay, it's going to be $1 per apple. I know you got the number. I did this with my 7-year-old the other day. She got the number right. She was really confused why I was making her listen to an economics presentation, okay? But she got the number. $10, 10 apple, $1 per apple. Let's call this 2019. This is our starting point. This is when things were kind of in parity. All the supply chain, the things you could purchase, the money in the system. Now, if the argument was and has been, get the supply chain, get that back to where it was, and inflation will be solved, let's think about this. In those early stages of COVID, we added money to the system. We goosed demand. Okay, so I'm going to add that money in, $13, $3 more, 30% more money in the system. Again, it's continued to rise. Now we're at 42. And let's keep the supply chain unchanged. You didn't lose a single job. You didn't lose a single unit of production. If the argument is get the jobs back, we'll put them exactly where they were. And I want you to think to yourself for a moment, with $13 and 10 apples, what's going to happen to the price of an apple? And the answer is it's going to go up. Now, during COVID, this pressure was intensified further because we didn't have 10 apples. We had 5 apples. And with $13 and 5 apples, it's $2.60 per apple. If we had stayed in the depths of COVID, added money, reduced output, inflation would be even higher than it is today. And we'd have further to go. But here's the thing. This is America. And we don't sit idly by. When the pressure comes, when difficulty comes, we fight. We figure out new ways. You can't come into my restaurant, I'll bring the restaurant to you. I'll figure out a new way to do delivery. I'll put a tent up outside with open air on both sides if I need to get fans to flow it through. You tell me, regulators, you tell me what I need to do, and I will do whatever I need to do because I want my doors open when this is all said and done. And think about how incredible it was that we had COVID in 2020. Imagine if we had had it 20 years earlier. You remember Y2K? Y2K, when we were concerned that the computers were going to go from 99 to 00 and the U.S. missile system might shoot off, right? Back in 99, 12/31/99, I was standing in Naperville, Illinois. It's 26 miles straight west of downtown Chicago, and there was a tension in the air. People were looking and saying, are the lights going to go out? Am I going to go home and that VCR is just going to stop working and the tape I picked up from Blockbuster is useless? And the clock struck midnight, and what happened? Nothing. Now, I think back to it today, and I think, how in the world were we so worried in Chicago? Right? We were in the central time zone. It had happened an hour earlier in New York. How did we not know that everything was going to be fine? And I think about how much has changed. In 99, in the 2000, we didn't have iPhones. If somebody was in another state on the East Coast, they could have called you. Maybe they could have texted you. If you were home and you went online and nobody else picked up the phone and stopped your dial-up connection, right? Maybe you could have looked it up and found it on Yahoo or American Online. Okay, but think about how much has changed. In the year 2000, Amazon was still a bookseller. Amazon was competing with Barnes & Nobles and Borders. We went into COVID, and they have same-day delivery. They have next-day delivery. You buy it today before noon, it's going to be there tomorrow. That was unheard of just 20 years prior. We had the capacity, we had the tools in 2020, not because these businesses were sitting there in the year 2000 and 2005 and 2010, not because they were sitting there and saying that pandemic's on the way, we better be prepared, but because we live in a country with private property rights and the rule of law, with entrepreneurs, innovators, the best education system, the best higher education system in the world. That's why English is the international language of math and science. We have the best institutions. We attract the smartest minds, and they compete day in and day out. They're working out of back rooms. They're working out of garages to bring the next innovations that we didn't even know we needed. And so we enter into 2020, we go into COVID. Our ability to respond, to get back, to get this Apple production back to where it was amplified because of all of this work that took place over the prior 20 years. The work that, quite honestly, is what moves us forward over time. We get caught up in the downturns. We get caught up in the pullbacks. But this activity is what moves us forward over time. This, to me, is the bigger story. So the apples come back, and the Fed says, yeah, look, the apples come back. Now we're spreading these $13 over 10 apples. Look, we moved from this scenario with 260, and now we're to this one with 130. Look, inflation was transitory. And you say, well, wait a second. When you said inflation was transitory, people thought you were going back here, that we were going back to where we started with $10 and 10 apples. And they're like, oh, no. See, here's the thing. We're not taking this money out of the system. Why aren't we taking the money out of the system? We've tried that before. We actually did that in the 1930s. It caused the Great Depression. Not a very good idea, particularly in a midterm election year. So here's what we're going to do as the central bank. We're going to raise interest rates. And as it's more expensive to borrow and buy a house, borrow and buy a car, borrow and invest in a business, we'll create fewer loans. So this money side will now stop growing. And we now have two ways to get this balance, right? In order to balance 42% more money with how many more apples are we producing today? With the declines in the first and second quarter, we're up 2%. Okay? So 42% more money, 2% more goods. How does this balance? How long does it take to balance? Well, you have two options. You can produce more apples, or you can move the price. You can have that money chasing the goods. And that's the primary driver. This year, do I expect that we're going to see economic growth? I do. I think we're going to see some improvements in the second half of this year. I'm not expecting spectacular growth. Last year, we grew 5.5% output. It was the single best year since 1984. This year, look for 1%. Modest, moderate. And what does that mean on this side? We go from 2% to 3%. This gap is still significant. How are we feeling it today? It's with inflation. The prices are moving. The value of the dollars, the gas, the wheat, the corn, the soybeans, the coffee, the backyard apparel, the luggage, the airplane tickets, the rental cars, they're repricing as this money flows through the system. I think, to be honest, inflation is going to be here beyond this year. I think it's going to remain elevated in 2023. I think it's still going to be elevated into 2024. The Fed is battling. They've stopped growing the money. That's a good start. But now it takes time to get these pieces in order. And during that time where it's getting in order, we're going to continue to see some increased volatility. We're going to continue to feel some of the bumps. Now, with the Fed responding, okay, the 10-year Treasury, the base rate, one of the key base rates in the economy, it jumped earlier this year. In fact, it ended last year at 150 basis points, 1.5%. In the middle of this year, it had exactly doubled. Okay, by the middle of this year, it had exactly doubled. It was at 3%. Now it's bounced around a little bit in here. The markets are trying to figure out, when do we have a recession? When does the Fed start to ease? And they say, look, this 10-year Treasury, which is going to be paying us out over the next 10 years, yes, the Fed may be higher this year and into next year. But as we get into 24, 25, 26, once inflation's under control, rates are coming back down. I don't expect the 10-year Treasury is going to run to 6, 7, 8, 9, 10%. I do not see the scenario where interest rates are rising to where they were in the late 70s into the early 80s. But for now, they're elevated. And this shock, this movement, this shift from the Fed saying one rate hike to, oh, maybe it's 14. I'm glad they're taking it seriously now. I'm glad that they're addressing inflation, but with that, we got whipsawed. The markets felt it, consumers felt it, even the fixed income side of the equation, which is usually the ballast, it felt it. Now I look at this chart, and here's one thing that sticks out to me. At 3-ish%, which is where we were in the middle of the year, it's actually down a little bit from that. Yes, that's up from a year and a half ago. And this is what companies are saying. This is what they're screaming on CNBC. Can companies survive under these higher rates? Well, before 2009, they weren't anywhere close to this. They couldn't get a 3% rate. Not in the early 2000s, not in the 90s, the 80s, 70s, 60s, 50s, or 40s. The monetary policy, the cost of borrowing still remains low by historical standards. Okay, yes, the Fed is going to keep raising interest rates to get inflation in check. But these companies, again, in here, they did what those individuals did when they refinanced. They built up reserves. They put cash on the balance sheet. They prepared for the time that we're facing right now, and they're putting that money to work. Are they doing that effectively? Here's my last slide, but maybe my most important. Okay, you go back to the financial crisis. It took us 1, 2, 3, 4, 5 years for earnings to come back and set a new high. 5 years. This was a more typical recession. It was a debt crisis. It's harder to reset. Then we had the recovery, and what was this? From 17 to 18, we saw a jump in the earnings. Well, that was the tax cuts. The tax cuts that were supposed to reverse this year. We were supposed to have a higher personal tax rate, higher corporate tax rate, higher cap gains rate, and changes to the inheritance laws. Now, there were some tax changes, a 1% change to buyback tax. There was a change to the minimum tax on companies, but this was very minimally touched. Okay? But I want to remind you of something. What happened in 2018, this year, when earnings rose? The markets fell. Why? Because anxiety was high. We were worried about U.S.-China trade conflict. We were worried about a potential government shutdown. We were worried because the Fed was raising rates. So the economy fell despite the data suggesting we should have been moving higher. What happened in 2019? In 2019, earnings barely moved, but the market boomed. Because emotions can win out in the short term. Uncertainty can win out in the short term, but the math wins out over time. The data, which is apolitical, the data, which doesn't care about our emotions, the data wins out over time. COVID hits, the numbers fall. Then we get into 2021, and what happened? We boomed. We went from $155 per share in 2019 to $200 per share in 2020. Now, where are we today? Well, I'll give you the numbers that we got from Bloomberg. This is not my forecast. I went to the 83 analysts who put pricing on the markets. Some are too high, some are too low, but on average, they're about right. And here's what they're looking for this year and next. Continued growth in earnings. Now, people ask me, what about revisions? I heard on TV that companies missed expectations and they revised lower. And I said, yeah, you're right. Some of the tech companies have done that. And they're the big names, the names that everybody likes to listen to. What's happening is we're seeing that taken care of by rising earnings, rising expectations from the energy companies, the materials, the utilities, the companies that, quite honestly, are not sexy enough to get coverage. People don't get excited to own a materials company. But they are producing earnings, and they're expected to continue producing earnings in the next year. Now, I want to end on a quote from arguably the greatest philosopher of the 20th century, Iron Mike Tyson. Back in 1996, Mike Tyson had a famous quote. He said, everybody's got a plan until they get punched in the mouth. And what he's saying is look, you come into a match. A boxing match, you run into adversity in life, you have plans on what you're going to do, how you're going to react. But when the fists start flying, the punch, the adversity actually hits, people start acting off emotion. The rationality goes out the window. And Mike Tyson was saying this. He had a fight coming up with Evander Holyfield. And Evander Holyfield had said, look, I'm the underdog. Tyson's a 15-2 favorite in this fight. If I'm going to beat him, I got to tire him down. And I think I can do that. I got to avoid him. I got to tire him down. I got to bring it to the later stages of the fight. Then I've got a chance. And they told Mike, hey, Holyfield's got his plan, and Mike waved him off. The reason I love Tyson's quote this year is not because, we've taken the body blows and emotion has kicked in. He was right about that. The reason I like the quote is because Holyfield won the fight. Why? Because he stuck to the plan. Because when the adversity came, it wasn't easy, but he said, look, I know where I want to go at the end of this thing. And that plan I made with the rationality in place, that plan I made before my emotion was running high, it's still the best plan to get me to where I want to be. He didn't know what was going to come in those initial few rounds of the fight. I can't time this market. You can't time this market. The market timing Hall of Fame is empty. But in times like this, the plans, the discussions that you were having with Brian, with the Ford financial team before any of this started, those plans that you make, because history shows us time in the market is more important than timing the market, they remain your best source of focus today. And we continue to have these conversations with Brian and the whole team. We are going to continue to watch the data. We are going to continue to dive into the numbers through the turbulence. And again, buckle up a little bit. I wish I could tell you we start setting new highs this year, but I think as we continue to fight inflation, it may be a bit rocky. I don't see the hurricane on the horizon, but there's some rain clouds. And so there's ways that we can, in this environment, be very intentional about those allocations. That's the conversation we're having. That's the data doing the talking. Now, that's a lot of listening to an economist on any given day. Thank you for hopping on. Brian, why don't I pass things back to you with that, and we can see if any questions came in.
Absolutely. Well, it looks like you have preemptively answered many of the questions because the chat box is empty at the moment. Although I will take this opportunity. We've been going for a little while. If there is something in Andrew's slide deck that you have a question about, whether it's inflation, GDP, S&P 500, now would be a great time to get his input. I will say though that if you are like me, sometimes I will jump off of one of these webinars or out of a conversation that I've had with somebody and then remember, yes, there was a question that I had and I forgot to ask it. You certainly can email us. You can email your advisor directly. You can email me, or you can just email the general Ford Financial Group inbox at info@FordFG. And if it's a question that's maybe tailored for Andrew, we can certainly pass that along. Or if it's for us, we can answer it after the fact. But Andrew, I agree with you. There are storm clouds on the horizon, and we may not get back to square one this year, but it doesn't mean the future is bleak, right?
No, not at all. You tell me 5 years out, 10 years out from now, I think we're going to be setting new highs. 10 years out from now, I think the world's going to be a place that just like 20 years ago, we can't even imagine. There's tools that we got. Things like the tools that we use to bring a vaccine to the market in less than a year. We've never done that before. There are technologies, there are learnings, there are improvements that businesses learned how to make to get through COVID. And those efficiencies aren't going away just because COVID is now behind us. I think a couple of years out, once inflation's in check, there's going to be some tremendous things in our future. It's staying the course until we get there.
Absolutely. I cite an example with a lot of people. And if you're somebody I work with that's on the webinar, I apologize if you've heard this already. Like with Zoom, for example, we're doing this on Zoom. I will never do a Zoom happy hour again in my life. So that efficiency will not flow through. But similarly, my wife is never going to take our fighting kids into the grocery store with her ever again. She's just going to dial it up on her app and back up to the grocery store and have it thrown in her trunk. So there are efficiencies that are going to live past COVID for a variety of reasons, not just related to COVID. I do have a question on the Q&A. And it's from Tony Molina. He's asking, bottom line, have the recession fears been overblown? What do you think, Andrew?
So I think concerns that we're in a recession right now are overblown. Here's what I think. I think the market is largely priced in that we're going to have a recession eventually. And here's the thing. Let's say that we were in a recession, that the MBER comes back based on their guidance. I don't think they're going to call it a recession, but let's say they do. Okay. Are people going to feel comfortable And moving forward, if in the third quarter they say, hey, that recession is behind us, if inflation's still at 8-9% and the Fed is still raising interest rates, are people going to be comfortable that everything is behind us? And I think the answer to that is no. So I think the markets are still pricing in that there's more to come. Now, on the average side, in a normal pullback from a recession, we see the markets pull back 20 to 25%, right? And we basically saw that. So the market priced in a lot of it. I think if you're watching TV, it gets overblown. They overblow everything. The government shutdown that we had back in 2018, CNBC ran a ticker in the bottom corner talking about how much it was subtracting from GDP for every day that it was ongoing, and then the GDP data came out and it moved in the opposite direction. And magically, that little counter went away. I must have missed when they issued an apology for the fear mongering. But it depends on where you're watching. I do still think that the market's pricing in turbulence ahead, and I think some of that is justified because we still have some things to work through. But I'm not expecting another go around like what we saw in the first half of this year. I don't think that this was just the initial wave and the worst is yet to come. I think that a lot of it's been priced.
Yeah. And Andrew, I think if we're talking about economic recession, I find in talking with people when we say, are we going to have a recession? There are visions of 2008.
Right.
And maybe you could speak to this quickly. And then I have one more question for you. But,
sure.
In our view, this does not shape up to the fractured system that we had in 2008 and the kind of destruction that went on there.
No, and remember that was debt too. That was a debt crisis. Consumers and businesses were stretched. The economic gears came loose. The banking system was having difficulties. This is not that situation. If I had to compare what I expect the economic recession will ultimately look like, go look back at 1991, right? The unemployment rate raises 1% or 2%, not 5, 6, 7%. I don't see double-digit unemployment in the future. It's the fact that when you make it more expensive to borrow and invest in businesses and buy the houses and buy the cars, that activity stagnates. So you don't see a massive drop. It's not that we fall off the precipice. It's that growth stops, it slows, it sees a moderate decline as interest rates move higher. But this is nowhere near, I expect, the magnitude of what we saw in 08-09. The fact that it is not a debt crisis is critical.
That's a great answer. We'll finish up with this one last question from Darren. Darren, part of your question, I think, relates specifically to your stuff with your IRA and retirement income from there. So I'd say for maybe the first half of your question, it'd be good to check with your advisor on how what's going on right now is affecting your IRA and your income from your retirement account specifically. But Andrew, this part of Darren's question is for you about, will he be able to make up losses in his investment portfolio, do you think, even though he's no longer contributing? Are investment portfolios going to be able to repair themselves from what's gone on this year, do you think?
They will over time. Again, I don't expect to be setting new highs this year. And I think it may be difficult to get to new highs next year. But if you said, 3, 4, 5 years from now, yes, I think that your holdings, even if you didn't add another dime, are going to appreciate over time. The value of their production is going to rise. They're going to continue the output. I expect that the markets 3 years, 5 years, 10 years from now will move higher. It's going to be a patience thing right now, just as we get through this reset period and they can really get back to those core fundamentals.
That's great. Andrew, thank you. Michael, thank you. We really appreciate you joining us and giving your input. We talk often with our clients about what's going on with the markets and economy and how it affects them, but it's so refreshing to hear another viewpoint on this, especially Andrew, with your kind of expertise and background that you have, being so steeped in the data here. So we will leave it here. We're 50 minutes in. If you would like to see a replay of Andrew's presentation, email your FFG advisor and we will be able to get you a private link to be able to see the replay so you can kind of check back in with some of the data that we reviewed if you want to go more slowly or be able to pause or do some of those kinds of things. So thank you, everybody, for attending. Mike, Andrew, thank you for your input here as well. We'll leave it here for today, and we'll check back with you maybe over the winter time. We'll try and do these webinar series again. So thanks, everybody.